We have with us Joel Boeing, who is with Edward Jones Investing, and I would assume you're a financial planner.
I'm a financial advisor, and it's great to be here. I appreciate the opportunity to come in and talk with you.
Great. We're going to be talking mainly about investments, how people can get started, and perhaps even people who have some investments, if there's anything right now this time that we should be doing about that.
Absolutely.
So how would you suggest and recommend that somebody who perhaps hasn't had any investments get started in that?
The biggest thing to take into account is the fact that a lot of folks are under the conception that you need to have a lot of money to get started. You don't need a lot of money. You start out with small dollars. With us, if you have $25 a month that you could put in, you can actually start a retirement account, tax deferred or tax-free growth in a Roth IRA.
All right, so right there, what does tax deferred mean?
Tax deferred means when you put your money in, let's say you made $100,000 this year, and you put away $5,000 into your tax deferred plan or traditional IRA, which is the same as a 401k plan through a lot of businesses. The money goes in pre-tax dollars. So you're not paying tax on those dollars today. So you can write that off of your taxes. Now if you go into a Roth IRA, you make $100,000, you put in $5,000, you tell the government you made $100,000 this year, so you pay your tax today, but the growth on that money is all tax-free. So over time, if you'd put in $100,000 out of pocket into a Roth and it grows to $500,000, that $400,000 of growth will be tax-free dollars. You'll never pay tax on that. Now there are limits to how much your adjusted gross income is, so you have to be careful and talk to a financial professional to make sure that you are falling within the parameters that the IRS has stated.
So that's a pretty, $25 a month, it would be better to do more, but
Absolutely. But if you're a young person and you're starting out and you can put away $25 a month, put away $25 a month. If you do 50, you do 100, whatever you can do. But right now people are scared. They've got very emotional about the markets. They've been bouncing around, which is understandable. But if you buy quality products and you review them, don't just buy them and just forget about them. It's not a buy and forget. We're a buy and hold strategy. You buy quality products, you review them frequently with your financial advisor, and make sure that they're still producing how you want them to and what you need to. You know, it's all about the time value of money. It's amazing the compounding, how much money a little bit that you start with will grow over time.
You mentioned products. So a Roth IRA, that's a product.
A Roth IRA is an umbrella. That's an umbrella for the government to know what type of situation you're putting your money into. Under that umbrella, you can buy any different product that you would like to. Stocks, bonds, mutual funds. There are a lot of different things that you can purchase, but it's a matter of how are they going to tax you on it.
So a Roth IRA is an umbrella, but you had just said before that it was tax-free.
It's tax-free growth.
Tax-free growth.
The money that you put in today, you will pay tax on.
Okay.
You'll claim that this year on your taxes, but it will grow. All the growth will be tax-free.
Okay.
A traditional IRA, a 401k, a 457B, those are tax-deferred plans, which means I'm not paying tax today, but when I take it out, then I will be taxed on what I take out as I take it out annually. You know, as you take that money out, that's when you're going to pay your taxes.
Okay. And that's why we need professionals to tell us.
That's right.
That's all these differences.
That's right. That's why I do what I do. I do this to help people out, and there's a big misconception with, oh, I don't have enough money. Okay. When you come out of college and you go into your first job and you get a 401k, hopefully the company is matching what you're putting in. If they don't, last year, you know, with the market doing what it did, a lot of companies stopped that. But if they continue to contribute, you're starting out with 3% of your salary, 2% of your salary, 5%, whatever you can put in, you put away. That over the course of time will grow tremendously, or has the potential to grow tremendously. Now with any investment, there is risks. The more risk you take, the potential for greater rewards, the potential for greater loss. So you have to actually build a portfolio, which is how your money is invested, spread your money out, and make sure you're talking to somebody that can help you with that. That's what I do.
And when you're talking about portfolio, that is a variance of diversified products.
Correct. How your money is spread out. There are different categories in the portfolio. There's income, there's growth in income, which are companies that pay a dividend. There's growth companies, which are companies that pay a very small dividend or no dividend, and then there's the aggressive market. So in the aggressive market, great chance for reward, bigger chance for loss. In the income area where you're buying CDs, bonds, things like that, it's more of a fixed rate of return over a fixed amount of time, a slower moving vehicle.
So for a younger person who has 30 years until retirement, hopefully, you would be looking at something that is perhaps a little bit more on the aggressive side.
Yes and no. Yes, you have the thought process down. You've got plenty of time to make money. If you lose some, you've got time to gain it back. On the other hand, the way we do it is I want to know what is your risk tolerance. You could be 25 and say, I don't ever want to take any chance. Okay, that's fine. Realize that the growth is going to be much slower. You can leave your money sitting in cash, which is a safe investment, or a money market. Okay, you can do that, but the chance for growth is very limited. So the right way to do it is do a risk tolerance questionnaire, which is, we want to know about you, how you feel, and then diversify you from there and build you a quality balanced portfolio.
So, and diversify and balance is once you develop that risk tolerance, then let's say you have a moderate risk or average or medium or your 50% or whatever, how you qualify that, you'd have a little bit of aggressive and a little bit of conservative and somewhere in between.
That's correct. That's absolutely right.
Balance it out. And as someone who goes through the work continuum and becomes closer to retirement age, do you make adjustments in there?
Yes, that's the buy and forget versus the buy and check. Okay, my job is to make sure that we stay balanced for you, and as you get closer to retirement, it's time to take some of those gains off the table and protect some of them. Okay, as you can see what the market did last year, a lot of people were getting very emotional about the investments, and it's tough for myself to tell you, hey, it's time to bring some of those profits and move them and protect some of them. People will sit there and they will say, no, if we've made so much money, it's going to keep going. Do you know that? I don't know that, and I'm in the industry. I can't guarantee anything. I can guarantee you that I'm going to balance you, and we have the potential for gains. We also have the potential for loss, but it should be emotionless. When you invest, you buy quality, and you hold on to it. And then you review it. And when you review it, things change. You had an inheritance, somebody passed away, you lost your job. There's all types of things, and it's constantly changing. Life is not a straight, flat ground, here we go, we're just going to run right through it. As we all know, it's a roller coaster. It's ups and downs all the way through.